Welcome to the ICT Mastery Blueprint, episode number 10. We're finally going to start getting into some very specific concepts, not more these general concepts on how to read price like liquidity and imbalances, which, by the way, if you haven't seen the first couple episodes, I would highly recommend you watch those first before continuing, because we are going to go into some more in-depth concepts, kind of helping you learn the concepts that you can potentially use to frame your own trading model. So today, we're going to be talking about the first presentation fair value gap. I'm going to move my camera to the top right, and we're going to talk about the first presentation fair value gap. So, what is the first presentation fair value gap? The first presentation fair value gap, it's very simple, right? It's literally exactly what it sounds like. It refers to the first fair value gap that forms after a certain time. Now, this concept can be used in different time intervals. Primarily, in this video, I'm going to be focusing on the first presentation fair value gap after 9:30 opening price. So, for example, the first fair value gap after 9:30 opening price, which would refer to, literally, the first fair value gap that forms after 9:30 candle prints, right? So, that's one example of the first presentation. You can also have the first fair value gap after midnight opening price. This would be your first fair value gap for the day, right? Maybe you look at the first fair value gap after 9:30 for the week, which would be your first regular trading hours fair value gap, and you can use that for the rest of the week. You can also use the first fair value gap after 1:30 p.m. Eastern time or 13:30. That's PM session opening price. So you can use this concept kind of in fractality with multiple time intervals, but for the most part, I'm going to refer to two main fair value gaps. It's going to be the first presentation fair value gap for each regular trading session hours open, which would be 9:30. So every single day, the regular trading session hours for futures starts at 9:30 Eastern time, 9:30 a.m. Eastern time. That first fair value gap is the one we're going to be focusing on, because that's the one that you can use in multiple weeks, or multiple days in that week, I should say, and also that current trading day itself. So here's an example. We have 9:30 opening price right here. You can see we put in a first fair value, the first fair value gap after 9:30 opening price. And then in the same example right here. So just a simple diagram if you want to screenshot this for your notes or whatever. So what is the importance of this before I get to some examples? The trading algorithm refers back to this as the first imbalance. So imagine the market opens at regular trading hours, 9:30 a.m. Eastern time. We put in a fair value gap. That fair value gap will be referred back to algorithmically, right? Because it is the first imbalance, right? It's the first opportunity to offer efficient delivery, rebalance inefficiency, offer fair value, etc., etc. Now, I'm not saying every single first presentation fair value gap you can take long or short. I'm simply outlining that it's going to be referred back to algorithmically. And what do we know about the algorithm if you've been paying attention thus far? The algorithm can only draw for four reasons, right? Higher or lower for imbalance or liquidity, right? We also know that the algorithm we can use to gauge order flow, right? So when we see first presentation fair value gap, we can see how the algorithm refers back to it and kind of what happens to try to gauge the order flow and the narrative that's going on. So for example, in a bullish situation, we can look for first presentation fair value gap to act as a confluence for higher prices. It doesn't matter if it's bullish or a bearish fair value gap, right? If we are bullish, then we would look for first presentation to outline potential higher prices, and then vice versa for the bearish scenario. So for example here, if we had a bearish bias and we have this bullish first presentation fair value gap, but then we inverse it, well, that's what we'd want to see. If we're bearish, we should be using this fair value gap as a confluence for shorts, right? So it all depends on your narrative and your bias. It's not simply first presentation is bullish, therefore we're bullish. You have to use the fair value gap the way the algorithm is going to refer back to it. And over here, it refers back to it as an inverse fair value gap, and we trade lower. And then obviously for the bullish scenario, we have a bearish first presentation fair value gap after 9:30 opening price. We inverse it, refer back to it, and trade higher. I will go over multiple examples live in front of you guys, trades that I've taken myself, and we'll go over it. So here are the ones we're going to be focusing on primarily. It's actually going to be the first two, but again, you can use this concept. I primarily trade the morning session, so we're just going to go over those examples. They're also going to be the most clear examples because the volatility that comes into the marketplace is very nice. So first fair value gap for the week, we're going to refer to the first regular trading hours fair value gap for the week. So the first presentation on Monday. We're also going to refer to the first fair value gap for New York session each day in the week. So we'll go to the charts. I'll give you guys some examples of trades I've taken, trades that you could have potentially taken, or at least outline how you can use the fair value gap in your trading. Whether or not you actually want to implement this is completely up to you, but if you do trade 930 open, I would highly recommend adding this kind of concept to your arsenal, just so you can get a better read of what the algorithm is repricing to and referring back to offer higher or lower prices. Here I am with the most simple, basic example number 1. We have New York opening price right here. This was literally straight from the PDF. This was yesterday, by the way, and we did try to get long on this move, but just the risk reward was not what we were looking for. But here we are, just going to give you an example of first presentation. Here's New York opening price. So as soon as 930 comes, we start looking, right? We're not looking anything to the left. It has to be after. So we're looking here, and we don't really have any imbalances, and all of a sudden, boom, we have this very obvious, and that's what you want to see, a very obvious fair value gap, ideally, forms. So I'm going to mark it out with this yellow box, 1P FVG, you can see right there. This is your first presentation fair value gap. What does the market do? Well, it aggressively inverts this fair value gap. So if you were bullish, let's say for whatever reason you had, I don't know, an objective over here, right? This is just for demonstration purposes. You could hypothetically look for this fair value gap to be respected to offer higher prices, right? So we're not looking this as a bearish fair value gap only looking lower. We're looking this because we're bullish, first presentation inversion, and we're looking for it to offer higher prices. You can see the market trades right back into 50%. Did it trade to the lower portion? No, which is a really bullish indication. Did we close above? Yes. We close above there, refer back to it one more time, and then we start expanding higher. Then the market takes out the buy side liquidity pool, which is here, and then we take it out here, and then we don't get quite to it again, but then we make a higher high. I think this is a news candle or something, but hopefully nonetheless this makes somewhat sense in terms of how you can use first presentation at the base minimum, right? We're not even talking about bias or anything, just simply first presentation inversion, market refers back to it, and we deliver higher. This fair value gap is very specific. Now obviously it overlaps with this bullish fair value gap, but I'm going to go over multiple examples. This is just one simple example, so let's use the next one. So here I am on the next day with the next example. I'm marking out the first presentation fair value gap after 930 opening price. So 930 opening is right here, right? New York opening price. And you can see we have a lot of sloppiness, no fair value gaps. And then we finally put in a fair value gap. We trade above that fair value gap, and we actually put in an S&T here. And we trade into this wick, and this old bearish fair value gap. So let's just say for simplicity's sake, we want to annotate this bearish fair value gap that's been respected. Okay, so what happens here? We trade above New York opening price, engineering a low, right, below the first presentation. Notice here we trade down, we do not close below first presentation. It's still acting as a inverse fair value gap, right? But once we get that closure below, right here, right, we close below. You can see the body closing below. The next candle then refers back to first presentation. Look how high it wicks, but look at the close. Next candle again trades up into it, but does not close above. Next candle again trades up into 50%, does not close above. This is because the algorithm is going to send pricing lower because the narrative and the bias is bearish. So whatever you're aiming for, we're not talking about that in this video, but you can see we get the first presentation reclaimed bearish fair value gaps. Remember, we are bearish, so we are looking for it to be used lower. Over here, we inversed it and we trade all the way back up into the SIBI. Well, once we start pairing stuff like macros, which we talked about, I believe, for example, right here, this macro. Well, once the macro starts, we inverse first presentation, refer back to it with a very nice close, right? And then we trade lower. You can pair that with something like an inverse fair value gap right here, which we also talked about in this series. This inversion fair value gap right here, you can see the algorithm starts to spool lower. Let's notice again, as we retrace higher, right, going into lunch, in towards the 1050 macro, we trade yet again into first presentation fair value gap. We trade into it here, we put in a high, and look at the bodies. Like, not a single time do we close back above. The algorithm is referring back to this fair value gap yet again to offer another opportunity short. So I'm not saying every single time it's respected, use it, but use this in confluence with other concepts. We talked about CISDs and we talked about breaker blocks. High, low, higher high, lower low. This is a bearish breaker. So you can use this maybe to frame a model or a higher probability entry. You can see, for example, here, the market trades into first presentation, right? We sweep get a higher high, and we then get a bearish breaker. The market refers back to this breaker as well as this bearish fair value gap, and we send price to the sell side. See how you're starting to stack the things that we're talking about in this series and framing higher probability trade ideas. It's not simply, oh, first presentation for value gap, go short or long. You have to stack these kind of concepts with the macro, with the CIBI, with the inversion here, with the CISD, which is right here. You can see how all these things are starting to align, and we're starting to get higher probability ideas helping us read the algorithm's hand, right? One little thing simply cannot be enough for you to be like, okay, I see. But if I told you we traded into a bearish premium array, which is a CIBI, which we talked about premium and fair value gaps, inside the macro, on a day that we are bearish, we get a CISD, we trade below opening price, we get an inversion of first presentation, and on top of that, we get another inversion. Well, it's probably going to go lower. This is the algorithm telling you that it's likely to go lower. What if I told you we engineered sell-side liquidity, we retraced into first presentation in premium, retraced into that old order block that we talked about from the previous CISD, rejected first presentation, off of that level, we got a breaker, and we're going into the macro. Now, the macro actually starts right here, 1150 to 1010. You can see, I mean, the macro still gives you an opportunity to get a higher probability trade. And in that breaker, we also form a bearish fair value gap that we respect once, twice, and then we sell off, right? See how we're stacking so many confluences, discount premium, PD raise, narrative, time in the macros, the opening price, and now first presentation fair value gap, which is something you can use, hopefully, in your arsenal to find higher probability trade setup. Let's do one more example, and then we'll call this a video. All right, so for our last example, we have a Tuesday. We have New York opening price right here. And you can see we got a lot of consolidation around the opening range, not really any obvious presentable first presentation fair value gaps until, boom, we get this fair value gap right here. Now, we're not even talking about bias, but let's just simply watch price action using this first presentation fair value gap. So over here, right here, exactly at 952, we inverse the first presentation fair value gap. We then engineer a low, we trade into first presentation, rejecting 50% twice. Did we completely go through? No, but even though the body's closed lower, and you can see we end up running towards that sell side. Well, now that we've taken out sell side, let's annotate the price action here. We get a bullish change in the state of delivery. Obviously, we're taking out the sell side from over here, so we can annotate this. So we've taken out sell side, we get a bullish change in the state of delivery, we get a bullish breaker. You can see we're starting to see some bullish order flow. Right here at this exact time, 10:42 a.m., we inverse first presentation fair value gap on that day. In doing so, we also put in a bullish fair value gap of our own. And you can see what the market does. And this is also inside the 1050 macro. Well, the market refers back to it and then trades even higher. So see how we're using first presentation fair value gap for both sides. We can use it for this short idea, right? When we're looking for a manipulation into that sell side liquidity, as it inverses here and gives you the change in the state of delivery and the inversion and all that. And then once we have the right narrative and the right time, we then see our bullish order flow when we can use this first presentation again, this time for higher prices. And in this case, it's, consolidation around -2 to 2.5 standard deviations, which we haven't talked about on the series yet, but for some of you who already know. And then we get that move to -4 off of this first presentation inversion. So this would be a high probability continuation idea if you were bullish. Now, we're not talking about bias, and I know for some of you guys are going to say, oh, this is so hindsight. Watch me live trade every single day. I always mark out first presentation fair value gap, and when everything aligns, I use it as a confluence multiple times. So hopefully this was somewhat insightful. Obviously, as everything in this series, I recommend you backtest yourself, study it yourself. Don't just simply take my word for it. It's simply for you guys to start understanding and learning some of the concepts in smart money, like some of these smart money concepts, hopefully more clearly, with more understanding, more simple, I guess you could say, as someone who's studied it for a really long time and has put all the hours in backtesting. So try to backtest this, see if you want to implement this into your own trading. It's a very simple concept to implement. You can even just start marking it out. Maybe you don't want to refer to it, but start marking it out in your chart, see how it plays out. I think you'd be very surprised and happy with the results because it is something I choose to use in my trading. You don't have to use it in yours. There are 100 ways to trade. For me, I use it as a confluence. I use it to support my idea that's already existing. So for example, if I was looking for longs and we got the first presentation inversion, well, that would be a confluence for me. If I was looking for shorts and I see, okay, well, we rejected first presentation and we formed the CISD over here, which is the bearish order block, and also the original CISD. I say, you know what, this looks like a really good short for me. So hopefully this was somewhat insightful. We will continue this series next week. Hopefully we can keep doing videos every single week. If you have any recommendations on any specific videos, I do have a plan, but I don't mind adjusting that plan if there's something that you guys want to see more than others. And take care till next time. Peace.